80% of success is psychology, 20% is the mechanics. Don't get me wrong, I'm a strategist. The right strategy can save you a decade. But if you don't have the right psychology, you'll learn the strategy, you won't apply it. So psychology is the driving force that creates an extraordinary business and an extraordinary life.
Emotions and gut reactions often rule your investment decisions, which can be detrimental to your portfolio and long-term investment goals. Investing is a relatively simple concept on the surface: buy low and sell high. But more times than not, retail investors like you and me buy high and sell low, repeating over and over until we quit or go broke. I speak from experience when I say that emotion is the enemy of investing. But there is a way to monitor where you are in your investment journey by reflecting on the emotions you feel and correlating those feelings with the overall investment sentiment of the market. The best tool to help you achieve this is the Wall Street cheat sheet. I've felt nearly every emotion on the Wall Street cheat sheet, and I'm grateful that I have, because now I can share my experience with you. Let's take a trip down memory lane to see how my experiences investing in cryptocurrency correlate with the psychology of a market cycle. Chapter 1. Emotion. October 2017, I started to educate myself on crypto, but when I saw how quickly the market was increasing, I knew I didn't have the time to do my regular research, so I jumped straight in. For approximately 10 weeks, I blitzed through the belief, thrill, and euphoria stage. I experienced a bull market like no other, making money hand over fist on paper. It was amazing watching my portfolio increase after every refresh. But then, it was gone. In January 2018, the market started to go down, and as expected, complacency crept in. I called my dad to discuss what was happening, and we both rationalized that this was a temporary consolidation before things went higher. Little did we know, this was the beginning of the 3-year bear market. In the months that followed, I experienced anxiety, denial, panic, capitulation, all but anger, because I was just disappointed in myself. So much so, I stepped away from cryptocurrency for about 2 months to recollect myself. Soon after, I came to the realization that I wasn't wrong about my decision to invest. I was just wrong about the timing, because I got in at the end of the market cycle. After coming to that realization, I spent the next 3 years understanding the cryptocurrency market cycle in preparation for the next bull market, which has now arrived. As much as I wish my portfolio hadn't gone down more than 90%, in hindsight, I'm glad I was able to experience that, because I don't believe I would have been as prepared as I am today without having felt those emotions. I hope that sharing my story will help you prepare for the emotions you will feel as you come on this journey. Out of all emotions, I honestly believe the hardest one I've had to overcome is FOMO. No, it's not on the cheat sheet, but it should be. FOMO, also known as the fear of missing out, really does affect you. When you see projects increase 100, even 1000% in a day, it's hard to keep yourself from jumping in. But there are several strategies you can use to overcome your emotions when investing to make sure you are not emotionally compromised. Chapter 2. Overcoming emotional investing. It's extremely hard to overcome emotions through sheer will alone. That's where tools and strategies come in. These 5 simple strategies will help you make more logical decisions, which will keep you from chasing short-term gains or overselling in panic. Number 1. Resist the urge to follow the crowd. This is extremely hard to do because it's human nature for us to want to fit in and follow the crowd. I can't tell you how many times I've been called crazy over the last 3 years because I've always bought more crypto after each subsequent drop lower. You must trust the process and understand that there are leaders in every crowd, and it's in your best interest to be one of them or one of the early followers. Warren Buffett says it best: be fearful when others are greedy, and greedy only when others are fearful. Number 2, think long term. The cryptocurrency market is known for its volatility, capable of increasing tens, hundreds, if not thousands of percentage points in a day and losing all of those gains the very next day. That's why the best way to tackle the crypto market, and any market for that matter, is to invest over a longer time period, because the short-term volatility is mitigated by the long-term trend. Number 3, understand your risk tolerance. This is very important because your risk tolerance is unique to you, based on your nature and age. By nature, I'm a moderately risky person, but that's because I'm young and I recognize that I have nothing to lose. Worst case, I lose everything in this investment and I must make up the loss over the remainder of my working life. Alternatively, someone that is close to retirement may have a smaller risk tolerance because they have more at stake. Number 4, diversify your investments. That may mean that you diversify outside of crypto as well as inside of it, but the intent of this strategy is to mitigate risk and must tie in with your risk tolerance and investment strategy. Additionally, like most people in the crypto space, you may have a favorite project you believe in so much that you choose to invest in that alone. Not only are you showing yourself off from other prospective projects that could be more successful, you're also leaving yourself exposed to the very real possibility of being wrong. Number 5, avoid the hot hand fallacy. The hot hand fallacy is a psychological condition that people believe an individual is hot or cold depending on past performance, when that performance has no bearing on future outcomes. This couldn't ring truer for crypto because the market will get so hot you will start believing that it can't go down. But like everything, all good things must come to an end. Conclusion. In summary, you will never be able to cure yourself of the emotions you feel, but recognizing them in yourself may help you identify where you are up to in the market cycle. If you are feeling a great deal of euphoria and the consensus from everyone is that the market is going to keep going up, more than likely that is a good time for you to sell. Alternatively, when there is a lot of fear, uncertainty, and doubt, FUD, that is a good time to buy. I know it seems counterintuitive to go against the majority, but these are the methods that have worked for me. Thank you once again for watching. I hope this short video helps you recognize the psychological triggers you may feel when investing in this market. Try your best to be vigilant and fight the urge to follow the crowd. These videos are my way of paying it forward, and if you found this information useful, please pay it forward to somebody else by sharing this video with them. Every like helps with the algorithm, and when you sub and click the notification bell, you'll be notified when my next video drops. Of course, you don't need to do any of these things, but if you do, thank you for your support. My name is Chad, and you've been watching C2PO. I'll see you in the next one.